Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So in the last few weeks we've seen a huge crash in the stock of MetaPlatforms, formerly known as Facebook. And in this video I really wanted to kind of go and investigate the reasons for that, and also stick around to the end because we'll do a bit of an intrinsic value of the stock as well. So let's get on with the video. So let's go and take a look at the recent decline of the stock since September 2021. And we can see here that the stock hit a high of $382.18, and that was back on the 7th of September 2021. And here we are just over 5 months later, and the close of the market was 206.16. So we can see that that's a drop of 46.1% in only 5 months. And if we just look at the price prior to reporting its earnings, we're looking at $323 down to 237.76, which is actually a 26.4% drop in a single day. And this wiped $252 billion off the price of the company in the market. So to see drops this significant, you would have to think that something is really very wrong with the company. I think the best thing to do here is just jump and look at a quick overview of the results from their latest 10K filing and also the last quarter of 2021. So here we'll just go and look at some of the key numbers. So we'll just start on the year-over-year numbers. So this is comparing 2020 to 2021. We can see here that total revenue has increased from just under 86 billion to 170, nearly 118 billion. And this is the first time actually that they've surpassed the 100 billion mark in revenue. And this was the 37% year-over-year change. Total costs and expenses are also up, but not as much as the revenue. So that means they're keeping the margins good and they're not actually decreasing their margin here. And we'll see here the income from operations, that's also increased by 43%, and the operating margin is increased from 38% in 2020 to 40% in 2021. And also a 35% increase for net income from 29 billion to 39 billion, and same kind of case in the increase for diluted earnings per share, which has increased by 36%. Now we're getting into the quarter over quarter results on the other side here. And this seems to be the thing that's actually probably really scaring investors at the moment. Because although you see that year over year, 37% in revenue growth, if we look quarter versus quarter for the 3 months ended December the 31st, you can see that revenue growth is actually a lot slower in that case than it was in the year. And also the costs have increased significantly relative to the revenues. So that means the margins are actually going to decrease there because the costs are growing faster than the revenues as well. And you can see the income from operations actually declined by 1%, and the operating margin has gone from 46% in 2020 final quarter to 37%. And also there is an 8% decline in the net income. And also we can see the same thing here in the earnings per share. And decrease in earnings per share is always one of those things that kind of really spooks investors. And now we'll just go down and look at some of the operational numbers that Facebook gives. So they've got this family daily active people. So this is their family of apps, which is Facebook, Instagram, Messenger and WhatsApp. This is still kind of increasing like quite a lot. 8% is still quite good. Family monthly active people, that's the same as the above, but people who use the platform, it's one of the platforms at least once a month. But here's also where there's a concern as well, because obviously Facebook's active users, the growth rate is starting to decline now, and we're looking at daily active users 5% year over year growth. But this is across the world. It's actually kind of, you're not really noticing much difference if you look in the US and areas they have high penetration. So that's one of the other things that's a concern. But I mean, when you reach this kind of many users, you're obviously kind of reaching the saturation point. So you can't be expected to keep growing forever because you're just going to be running out of people to actually have the apps anyway. And I'll just jump down here. And we can see that in this reporting period, they've actually added a new reportable segment, which is Reality Labs. So this part is the augmented and virtual reality related consumer hardware, software and content. And I think probably why they wanted to do this was to just obviously show how this is affecting the overall performance. Because we can see here that obviously advertising of course, is still the major way that Meta is making its profits. You will see there that the amount of advertising revenue relative to the other revenue is quite significant. And what's interesting to go down to and look at here is, obviously now we're kind of looking at the total income from operations and how this is split. So we can see here for the last 3 years, we're going 2019 to 2021. We can see there is significant growth in the family of apps for their revenues. And actually, Reality Labs continues to lose more and more money. But I'm personally not too discouraged by that, because if you see the revenues for Reality Labs, they're actually growing at a faster rate than the amount that they're losing. So you can see here we've gone from 500, so we're roughly doubling every year in the terms of the revenue. So 500 to 1,100 to 2,200. So that's kind of just doubling every year. But we can see here that the losses aren't doubling, because we're going from 4.5 billion to 6.6 to 10.2. So this is, I wouldn't be too concerned on this side of things, but I think they just wanted to make investors aware where the losses are coming from here. And now let's go and look at the CFO, Dave Wehner's commentary on the outlook, because this is another thing that I think has got people really concerned. They mention here that they expect first quarter revenue to be in the range of 27 to 29 billion, which represents a 3 to 11% year-over-year growth. And they expect the year-over-year growth in the first quarter to be impacted by headwinds to both impressions and price growth. So I went back and had a look at this, and actually the first quarter is always the weakest quarter for Facebook, as it was back then. It always gets the weakest revenues in the first quarter, but the thing that obviously the concern is here is this is the first quarter where they're lapping the Apple iOS changes, and you can see that mentioned in the point here. So they'll lap a period in which Apple iOS changes were not in effect. And this actually came into effect in Q2 of 2021. And Apple obviously introduced the option for you to opt out of data tracking, which had a big impact on the effectiveness of them being able to target their ads to people. So now I'm just jumping into the transcript from the earnings call. And one of the bits of colour that Dave Wehner, the CFO, gave was a question to Brian Nowak, who actually works for Morgan Stanley. What Brian is asking is to get a better idea of the headwinds around the ad targeting, to see what impact this is going to have on Meta going forward. And it's quite interesting because Dave Wehner kind of mentions an amount that they expect it to cost them in 2022. So we can see here that he mentions that the overall impact of the iOS updates as a headwind for their business could be in the order of 10 billion. So it's a really significant amount, and it's actually no wonder that investors would be a bit spooked by this, because if you're looking at maybe taking 10 billion in profit straight off the table because of this update, that's a significant amount even to a company like Meta. So let's just look at some of the key points which are causing some negativity around the stock, which could possibly be the reason for a lot of investors jumping out. So we can see that net income and earnings per share has declined for Q4 year over year, and the operating margin has decreased from 46% to 37% for Q4 as well, year over year. They've given weak guidance for Q1 of 2022. The headwind for iOS is expected to be around 10 billion in 2022. They've also seen a decline in user growth, rising competition from rivals such as TikTok, and uncertainty in the future of the company and its investment required to build out the metaverse. And of course, as any good investor, we want to look at those claims and try and rebut them as well. We've looked at the negative things there which could be causing a reason for the declining stock price, but we also need to look from the other side. Is this stock price drop realistic, or does it warrant to drop this much based on those numbers? Because these are still fairly good general results for the whole year. So obviously in the reasons for negativity, we saw that the net income and earnings per share had declined for Q4 year over year. But actually, as an overall year, the net income and earnings per share increased by 35 and 36% respectively. So this is a way of rebutting that claim that, okay, potentially less growth quarter, but actually the year over year results were good. The same case when we're going on looking at the operating margin, although the quarter over quarter was actually a decrease. If you're looking at the year over year, then we're kind of seeing a small increase of 38 to 40%. And in terms of the weak guidance, I'd rather that the company was kind of honest in terms of its guidance and not, be looking to lie about their guidance or try and hide it somewhere. That's really important when you're looking into the management team as well, that they're honest about what they're doing. And obviously we saw the iOS headwind was expected to be 10 billion, but obviously the company is looking for workarounds in targeting to mitigate the iOS updates. And of course, this could make 2022 a challenge, but beyond that, results should be improving again. And to rebut the idea that there is a decline in user growth, I don't think there's any denying that the user growth is going to decline. It's always going to decelerate as saturation is reached with the number of people. And of course, there's a rising competition from rivals such as TikTok. So my kind of rebuttal for that would be that competition is good for business and it encourages creativity. If you look at Instagram Reels, that was really a reaction to the popularity of short form videos from TikTok. And finally, uncertainty in the future of the company investments required to build out the Metaverse. And of course, the Metaverse is going to be a long-term investment for the company. But I believe the management team can succeed with the transition here as they've succeeded with other transitions before. So now let's jump in and take a quick look at some different valuation methods. And what we'll do here is we'll do the 3 fill town valuations, the 10 cap, the payback time and the margin of safety. And we'll see what range of prices we're getting for the stock. So here we are now looking at the 10 cap valuation, and I've done a separate video on all of these valuations. So I'll leave a link to that at the end as well. So I'm not going to jump in too deep to this right now, but for the 10 cap buy price here, we can see the 10 cap buy price is going to be $171.93. So that's slightly below where the stock sits currently, with the share price at the time of making this video is 202.08. And now if we jump into the payback time price, based on a 15% growth rate of the free cash flow, this is coming to a current payback time price of 219.91. So we're within buy range now with the current share price. So we could actually buy in at this point based on a 15% growth rate of the free cash flow. And moving on next to the margin of safety price. The buy price for this one is actually $209.85. And that's with our 50% margin of safety built into it. So we can also buy at this price here. And also, if we want to look even more conservatively, we can run the payback time price at 10% growth rate. And here we're getting the 8-year payback time of 175.25. So still slightly above, but we're kind of not too far off the range there. And based on a 10% growth rate for the margin of safety calculation, the buy price is actually coming to 89.69, which is obviously significantly lower than this. But that's just good to get an idea of the range of prices we're looking at here. And then it also comes back to the question as well, is the moat broken? And I think the moat is still strong at this stage. If you have to look at it because they have a really strong network effect moat. So there's so many people using the platform that there's a lot of opportunity to monetize those users in a lot of different ways. And they can still kind of find different ways to build revenue streams through the users. And with any investment, obviously really here we're relying quite heavily on the management team. They've seen a bit of adversity recently, and that's nothing really new for the company. They've gone through a lot of different transitions. They've gone from web to mobile, and then they've also gone from stories to reels. And you have to remember that back in 2012, people even had a question whether Facebook could actually even make any money. They've kind of found ways to generate revenue, and there's nothing to say that this management team can't actually find more ways to monetize their platform. So this is still, like for me, is still a fairly strong company. And if you look at the balance sheet, their balance sheet is strong, no debt, a good cash position. In my view of this, would it be it's a bit over dramatic, but what you need to remember is the institutional investors, they're really looking short term. So if Meta is going to suffer over the next couple of quarters or even the next couple of years, they're going to be straight out of the stock. Whereas us as kind of longer term investors, we can be patient and wait for this. We're not looking about what's going to happen in the next quarter or even the next 2 quarters. We're talking about what's going to happen in the next 5 or 10 years. Is Meta going to be a bigger company than it is today? And that's what you really need to consider when you're kind of making an investment decision. So full disclosure, I'm not currently a shareholder of MetaPlatforms, but it is a company that's been on my watch list for a while now. And I've just been waiting for this kind of opportunity to get in. So it's kind of interesting to have just looked at these valuations to see where we're sitting within that. And I think now is a potentially good time to enter into a position. But obviously, make sure you do all of your own research for this kind of thing, because obviously different people will have different valuations, different time horizons and things like that. So that's it for the video. I hope you enjoyed it. If you did, please give us a like. Also consider subscribing to the channel as well if you want to see similar content like this. And let me know in the comments what you think about MetaPlatforms. Do you think that this is just a minor blip, or is this the start of a trend that's going to see them significantly decrease their market kind of presence? I'm always interested to hear what your opinions are on this kind of thing as well. So thanks for watching, and I'll see you in the next video. Cheers.